guys. So welcome back. So let's start from where we left off. Like, let's discuss a little bit more into what I'm trying to say. Right. So first thing is how not to blow up your account. So it's about like not just telling people that okay you have to follow this so that like you can mm, don't lose, right? So it's about mathematically designing and validating your system that you are designing, right? In this case, home trading system. So how do you like mathematically prove, right? Because it's about hard-earned money that you are putting in, right? You don't want to go in without any clear idea. See, if you are starting any other business, right? You're starting grocery shop, you're starting a very big business like shipyard or whatever, right? So from little business to bigger business, there is at least there is a little bit barrier to entry. At least even if you want to go and do some menial jobs, right? You need to have a little bit of skills. But when it comes to trading, the problem is there is no entry criteria. There is nobody stopping you from taking the trade if you don't know anything, right? It's in a way it's a good thing because since it's not like blocked by anyone can get into it and then do things. But it also acts as a problem as well, right? Because people can get into it without having enough knowledge, right? So and then they start losing money and then they start blaming it on the market or others or even themselves, right? In many of the cases I did it, I need to get better picture, but still they'll not get the clear idea of what really needed. So see, as I said, it's a long process. First you have to ensure that you're not losing it. So for that you need to understand these four concepts, right? First you need to understand the risk management, right? As we said, like how much you should put in a stock, right? And what and in which way you put in, you will not lose your money before you learn this craft, right? You don't just if you want to start driving, right? You go to a coaching class and then you buy a small car and then learn with that and then you go and buy a like huge car or like you can drive whatever you want or something like that, right? So but in market also you have to take it in the slow steps. In the basic rule, right? As I mean, I have designed this system by studying a lot of successful traders, right? Who has different methodologies and they do things on their own style. But the one thing that is not at all changing, right, across all the successful traders, right, is the first four topics. They understand the risk management, they know how to think in probabilities, and then they know what is the edge, right? And then they'll pick the edge and the trading system in such a way that turn over that edge in a fast pace, right? Let me explain these things, right? So first, I know a lot of people, right? Even I am, when I started out, I was so much interested in options, right? Because I have a lot of leverage, I can make a lot of money quickly, right? So the thing I don't understand is risk management. I make like few wrong option calls, my whole capital is gone. Now I don't have money to do the trading, and then I have to wait for some more time or a year to get some more capital and then do the trading and so on. So all these successful traders, right, if you're thinking they are making a lot of risk to make a lot of money, that's not true. No uh, no good trader risk more than 2% of the capital per trade, right? So not the 2% stop loss, but 2% of the capital per trade. That means if you're having a 1 lakh capital, for example, right, you never risk more than 2,000 per trade, right? In the many good traders, right, they don't even risk 2%, they just risk 0.5%, 1%, like that, right? Even in some cases, they risk only 0.25%, right? So these things, how do you how do you just risk only little bit and still be a successful profitable trader? That's what we are going to discuss in this risk management thing. And then thinking in probabilities, right? This is one thing that is kind of specific to stock market, which is also a what to say, where people trip off, right? The thing is, uh, let's say I come to your school and then say that you study and then you attend your exams, right? You might get passed, right? Or you might get failed. You'll be confused, right? Even though you, I mean, irrespective of how well you did in the exam, you might pass or you might fail, right? You'll be worried, right? What is this? And then also, I'll give you another example. You go to your job, right, day in and day out. Some of the days, even though you have a good job, some of the months I'll pay you money, pay you the salary, and some of the months I don't pay you salary, right? So, but that's not the use case in any of our regular day-to-day activities. But when it comes to market, it is the nature, right? So it is the basic nature of the market. So you, even though you take right actions, you analyze your charts well, you understand your stock fundamentals, you know your situation, you put the right amount of money into it, but still, in some cases it will fail, in some cases it will lose. That's why you have to start thinking in the probabilities. There is a probability of this much success and this much failure, right? So that's how you have to start thinking that that in a simpler time, right? If the probability is like little bit confusing, so you have to think in terms of series of events, not every single event, right? If you have to make, if you consider it as in binaries, right? Always one. It's not going to happen. So you have to understand that in some cases you will gain 10,000, some cases you'll lose 5,000, in some cases you'll make 2,000, in some cases you'll not make anything or break anything, you'll just make zero, right, on that trade. But you have to think in the series of after 10 trades, right, how much I'm going to make, right? Or 1,000 trades, how I'm going to make 1 lakh trades, how much I'm going to make. Why? Because you are going to make 1 lakh trades, because you are going to do it for long time. So you have to start thinking in probabilities, which is not really applicable in any other like in life aspects or your job or anything, right? So that's why that's very important cornerstone to understanding how not to blow up your account or how to get more conviction in your system. And then the third thing is edge in your trading system. So what is an edge in your trading system? So let's take an example, right? We said we have to think in probabilities, right? So if a person, right, making for a trade on average, if he is making 5 rupees loss and then 10 rupees profit, right? On average, on the winning trades, he is losing 5 rupees. Sorry, making 10 rupees, and then in the losing trades, he's losing 5 rupees, right? Now, if he makes two trades, right, and then make one profit and lose one, he'll have a 5 rupees profit, right? As we said, this is not going to happen one after another or something like that, but it is going to happen across multiple trades, right? This probability is going to play out in across multiple trades. So take an example of 100 trades. So in the 100 trades, this probability play out. For example, if he has a 50% win rate, then 50% of his trades in no particular sequence will make him 50 into 10, 500 rupees. And then is losing trades 50 into 5, 250 rupees loss, right? So now he has 250 rupees profit after his loss is consolidated. He'll have a 250 rupees profit. So that's the edge. So now he has a positive edge. If, for example, somebody is having 99% win rate, right, and only 1% loss rate. In this case, consider an option trader who buys with all his money, right? So he makes profit one to two, two to three, three to four, five, four to five, etc., etc., etc. And in that one trade, he loses 100% of his capital. Then what's the point, right? So understand understand this, that just because you have a better win probabilities, right, win rate, it doesn't mean that you will be a successful trader. So you have to understand your edge by understanding what is your risk per trade and the reward per trade, and then what is your win and loss percentages, right? So that's how you understand. So just to give you guys an example, so a lot of successful traders out there, right, they have in the range of like 25 to 50% win rate, right? Who are like making huge money. If you are thinking that you need to find a system that is going to give you success all the time or whenever you take a trade, that's not true, right? So you need to think in probabilities and then have to play the edge. Since this is going to work in probabilities, make sure that you don't risk everything in a single trade, or make sure that you are able to make multiple trades using your capital before you blow out, so that your edge can play out. Okay, now come to the fourth point, turning over your age, right? So you identified your age in the case that we have discussed, right? That guy is making 250 rupees, right, for 100 trades, right? In a simplest form. So if he wants to make 25,000, how much time he has to do those trades? He has to repeat it for 100 times, right? So just because you have a better edge in your trading system, that doesn't mean you'll make a lot of money. You also have to design the system in such a way that you can turn over that edge multiple times, so that you'll make more money, right? So all these are essential, right, to not to blow up your account. Once you understand all these things, only you'll get the conviction to stay in this thing for long time, right? So like you all know, right? Like most of you are like married, and then have kids and all. So if you go and talk to your family, right, they'll all tell you, as long as you don't waste money on it, do whatever you want to do, right? So if you put it simply, so that's the first thing you have to address before you get into how to buy, what to buy, and all those things. But before even people understanding this, they start buying things, right? They'll just get into the second topic, that is what should I, or not even second topic, they'll just barely go into when should you buy, right? They'll read some technical analysis, some MACD indicator, RSI indicator, and then moving averages, harmonic patterns, whatnot, and then they start buying it before even understanding the basic mathematics, right? Of or all these things, right? Again, I want to re-emphasize on this thing. So whatever the system we are designing here is mostly like when you really get into the course and understand each aspect of this, right? You will feel most of it coming from common sense perspective rather than like something intelligent that is happening over here, right? So that's the beauty of it. So that's the reason, like you can see most of the successful people are they have different variety. There is no particular category of people that get successful in trading, right? Because they'll these are coming from a common sense perspective, not from any specific background is needed for any of this, right? So with that context, right, so you now know how not to go account. Then you come, once you understand it completely, you now come to the point like what should you buy, right? So just because a certain stock gives, for example, take a simple thing, moving average crossover, right? If 10 stocks are giving a moving average, if you put a filter somewhere, right, you will get that ten stocks are doing a crossover today or did a crossover today. Can you go and buy those all the 10 stocks, or all the 10 stocks are equally buyable? No, right? You have to understand what are the stocks, right, that has a institutional buying happening in it. So how do you find that institutional buying is happening in this? So you do that by understanding your fundamental and then technical analysis and macro analysis. So some of you are wondering like how much of this technical analysis, fundamental analysis, macro analysis we are going to do as part of this course or part of the system, right? I'll tell you. So since we also have a constraint, right, that 1 hour only we want to spend per day on this, right? So you can't go and get into your fundamental analysis in a very in-depth way. So you need to stop at certain point where it makes the stock eligible for you to make a bet on it, right? You make a or you take a choice that okay, it could go in this direction in a positive way. So how do like I mean, many of you know, right, already you're following, people are studying, right? Some of the people, right, when they do a fundamental analysis, they are a pure investors. They attend all the calls, right? The company is conducting about like what is happening in the company, what is the profit margin, and all those things, every single bits and pieces of it, right? But uh, uh, and then they go to the company, right, and then they go to the company's customers and ask about it, and then they go to the other end, that is the company supplier, to understand what is happening. So when somebody do all these things as part of the fundamental analysis, when the suppliers, right, consider this example, like when the suppliers don't get an order from the company, right, for this quarter, then they'll automatically understand that there is something is wrong in the company, even though the company is not going to announce that result, right, what is happening, the thing in one quarter later, right, or a couple of quarters later. From the supply, they can quickly understand that, okay, something is going wrong, I have to investigate, and then they can get out of the position or whatever, right, earlier, right. So someone like us, we don't have that capacity, right. So how do we do that? So we do just enough fundamental analysis, enough technical analysis, enough macro analysis to identify what we want to do, because those guys, right, who do those things, they have a concentrated bet, as well as they do it in a very large scale. Eventually, like, some of you might end up going in that direction, right, once you understand the system completely. Because whatever we are discussing it, right, it's not specific to this particular method, it's applicable for other methods as well, right. So you might go into such a direction, or someone could become a pure technical analysis algo trader as well, right. So those kind of things we'll do. So from our perspective, we'll do enough fundamental analysis to know, okay, this company, the activity that is happening on the company, right, or the buying that is happening on the company, right, that is meaningful only, right. That is the fundamental analysis that we are going to cover in this course. And then when it comes to technical analysis, as we discussed now, we are going to use the technical analysis to identify whether institutions are really getting into the stock, because only institutions can move the stocks. You can't really, like, for example, if you go and look at the ticker price, right, there will be like some 20 price points will be shown, and zero the, and in some other apps it could be 10 or something. If you want to just move the 10 paise, or like 1 rupee for the 25 5 paise ticker, right, you might have to buy for 1 crore rupee, just to move the price 1 rupee, right, for in a meaningful stocks, right. So we can't do that. So the price movement happens by the institutional traders, how they analyze the stocks very closer, and then they do that, right. So you first use the technical analysis to identify whether there is institutional activity in the stock. Then you use your fundamental analysis to confirm, okay, this is a meaningful and constructive action, because the fundamentals also supporting. Because if you see a technical action and then you see there is nothing fundamentally supporting a stock, you can still trade. Nobody is going to stop, or nothing wrong in that. But you, back of the mind, you know that, okay, I have to be little nimble on my feet, and then I have to cut the losses or take the profit quickly, because there is nothing fundamentally supporting this particular stock, right. So that's the idea. And then when it comes to macro analysis, there are so many areas, right. What is happening in China, why Trump is becoming a president in US, there is a Brexit happening, and then so and so happening in India, there is election coming, so many things, right. We are not going to discuss all these aspects of it. When it comes to macro, we are going to discuss only one aspect of macro, which is interested for us. Because, as I said, I mean, if any of you guys want a session on specific things, right, in very in-depth detail, we can have a separate session. But when for a one this home trader, it's not really needed, right? Because I'm doing it without even doing all those things on a daily or regular basis, or not even, I'm not looking at those newses anymore, right? So how do I do this? With only one macro analysis, which is interest rate cycle. At the moment, we are in a rising interest rate cycle, right? So that supports certain stocks that doesn't require to borrow money to run its operation or expansions. So when the cycle is interest rate cycle is like down, right? Interest rates are going down. You can actually invest in stocks that are like that can go very much by borrowing money in lower interest, right? So we'll just concentrate on the interest rate cycle. I mean, that's all. We don't. I mean, you should know how much is enough as well, so that you can do it on, or design the things on your for your own way. For example, I mean, we'll come to the a couple of slides later. I'll tell you like who will get into certain things in a more detailed or in-depth way, right? Okay, now you understand like what stocks to buy. You identify the institutional activity, you verified it with your fundamental analysis and the macro analysis. Cool. Now you wait for a buy trigger. Why? I know the stocks has an activity, but why should I have to wait for a buy trigger? Because it's simply a speculative aspect. That is, when you are saying something, okay, I formed a thesis that this stock is going to go up, I buy it, and then you should know, right, when when will you know it is not going in your way, right? So that testing should happen with a minimal amount, right? That we call it as a stop loss, right? So where you can identify a tight stop loss, right? That's what creates some buy triggers, right? A particular trigger, for example, if there is a moving average and then you put your stop loss below your swing low, then that's your buy trigger, right? So and then you there is a pullback to your support, and then you just put your stop loss below your support, then it becomes your uh, like uh, a testing place for your theory with a minimal losses, right? Minimal risk. So that's the idea of identifying when should you buy. Also, in some of the cases, right, when you are not very sure how much it's going to go low before it goes up and all those things, or you want to make sure that it goes up a little bit above before you invest your full capital. In those cases, you can do a staggered buy. That is, you don't have to buy the expected allocation at the same time. You can do it in trenches, right? Couple of trenches, or three trenches, four trenches, based on how much capital you want to allocate from the particular stock, right? Then, when it comes to the next point, you identify what to buy and you bought it. Then, when it comes to sell, you sell it in two cases. You sell it when the stock shows weakness or it shows strength. So what do you mean by showing weakness? Two cases. Whether your stop loss gets hit or the stocks moves up, but then it shows signs of going down, right? So that's when you can make a sale, right? And then we're selling into strength. If a certain stocks fly very quickly, right, the stock market so far indicates that when it happens, the stock would take some breather, right? But you can stay in the stock, right? But why? Because as we said, right, that is when the turning over your age part comes into picture, right? If you keep on the stock, it might stay in that place for like 3 4 months, right? For that time, you will not get any amount from your investment capital, right? No profit for that. So you might book the profit and then move on to the next stock, which has potential, shows a potential buying opportunity, right? So that's the thing. Okay, so now you know what to buy, when to buy, and when to sell. Now, like we discussed about risk management to not to lose, how do you like split your capital, put it in different stocks or different trades, right? The next thing that you should know is how to maximize it also, right? When you're losing, you want to lose little, that we have discussed as part of first. When you're winning, you want to make sure that you are winning big, right? So how much you buy comes from these aspects. That is, some of you might have heard, situation is more important than your setup, right? So the setups are like the stock chart or the fundamental nature of what is happening in the system and the macro support for the stock, or the situations or the setups that happens in the system. And then the situation is whether market as a whole is in a buying frenzy, right? Or it is in a bear market, right? So how do you identify it? Like simply looking at an index, some of the people could say that, okay, I can look at the index, it's going up, it's in a buy position, right? But if some of you are like in the market for quite some time, you would have noticed that index would move without actually the broader market moving. Okay, so how do I identify, right? You're not the index trader, right? You're a stock trader. You want to buy the stock that moves well, right? So you want to invest more when you are in such a cycle where all the stocks are moving. So how do I identify that the situation is in such a way that your stocks, I mean, you are doing very good. I mean, your stock, your positions could move very well, right? The same as I said, right? Based on the situational awareness, you can do your position sizing accordingly. When you are not sure about the situation, you can buy less. Also, not just for the single position, for the whole portfolio also, you can just allocate only 25% of or 10% of the capital at the moment, and then keep the rest outside, just to see whether this position is working. Then if the actions are constructive, and then you're starting to see that your trades are getting into the profit zone quickly, you can just increase your allocations, or you can take a step back and then reduce also, right, based on how the situation develops, right? So that's how we'll identify how much you buy when you're winning, sorry, how to increase your allocation when you're winning, and then how to decrease your allocation when the things are going against your predictions, right? So that's the how much you should buy concept. Then as discussed in the earlier steps, right, when you start doing these things, there are a lot of emotions you will go through, right? So if you don't know what your I mean, if you don't identify with those emotions when that is happening to you, you might tend to make a lot of mistakes, right? If you, again, as I want to go back to the successful traders, you go back to the successful traders, you refer their experience, you will identify that even though they are successful, still they are not clear of their emotions, right? Someone sometimes do FOMO trade, sometimes somebody will do revenge trades. All these things will still happen, they keep on happening even later stages as well. So that's why you have to identify when this emotions happens to you, and then try to cut back as quickly as possible. In these cases, two things will help. One is your risk management, right? When you make mistakes, if you are respecting your risk, it will help you from burning your hands, right? It will just with a small pinch, it will take you out. And then the second thing is, if you already have some kind of an idea about these emotions that you go through, then you can identify, okay, this is what I'm feeling and this is why I'm doing that, so I have to take a step back. Or in some cases, you'll also feel, okay, I am feeling very high, I'm making mistake. Two ways it could happen: very low or very high, and then you make mistakes. And it's not the only things, also some external factors. In a personal life, you are going through something, right? You might want to stay away from market, right? This also, again, you can identify with almost all the successful traders. When they are having some personal turmoil, right, they'll try to take those things and then put it into the market trading. So whenever this happens, they'll stay away. How do they get that? I mean, market could be in any state, right? It could be moving in such a very high pace in a positive direction, but they will stay away because they know that even it is moving in the right direction, they might make stupid errors, right? That's why they'll, because you have to, you are, you know your system on probabilities, not on certainty, right? So you have to embrace the uncertainty that comes with the market, right? So that's something you have to master, right? Your emotions, it's your emotions only, right? Not someone else. So you have to master your emotions to get better at it. And then what should be your routines, right? So you are doing trading, right? You identify the setups, and then you identify the buy triggers, and then you buy, and then you sell, right? Also, you do these routines, right, daily, to identify this buy and sell points. And what should you buy? You don't have to do it on daily basis, you can do it on weekly basis, right? Whenever you have a couple of hours time, you can do it on the weekend. And then when you are doing trading, and then when you on a monthly basis, you can take a step back and then observe, right? When you're doing trading, you don't have to every day every single rupee profit or a loss, you don't have to accumulate and then test check it. Only at the month end, you can create a routine to sit and analyze, check your trades. This trade I took it for this reason, this trade I took for this reason, and then this trade made a loss, even though I made a good judgment call, but it didn't make. But this trade, even though it made a profit, but it's a bad call, I followed some random news instead of following my system and made a profit. Why you should mark down and then try to avoid that? Because as we said, we calculated the edge of our system, not some random trading. Even though it could help you in one day, it could backfire in the other day. And it will become unpredictable also. As long as you don't have a predictability in your probabilities, you will never be in such a position to raise your capital, or you'll never get the conviction and confidence to do this for the long term, right? Also, you do this for monthly and then quarterly basis, you can check and see where I am at in this quarter, and then whether it's a good time to increase capital or reduce capital, or I have to add or adjust my trading system, because you will have 3 months worth of data at that point with you. You can adjust your risk management techniques, or your buy sell trigger techniques, or whatever, right? You can adjust it as part of your quarterly routine. So these kind of routines also we'll discuss in this particular topic. And then you do this, and then come to how do you adjust and improve, right? These are the routines. So exactly how do you execute these routines? So we do a post trade analysis, and then adjust based on the analysis. And then you also needs to know when you can add and remove capital, right? So one thing we all know, right? We are at some point in our life, we would like to push forward and then make more money in terms of your personal job, or even if you get a windfall from some other source, right? You should be able to put that, right? So, and what point you should put that, that's also your diary. And then you want to take out some money for some reason, right? You should be able to take out and then adjust your system, and the quantities that you buy, and then the like the stocks you want to trade. So those things you can do this, right, as part of your adjust and improve. And then obviously, as I said, right, you can also, as part of this, you can also personalize it the way you want, right? So these are the topics in a little bit of detail. I'm trying to explain you what we are going to cover, right, in this course. So now you get the picture, I believe. So you know how to stop blowing yourself. I mean, yourself from blowing your account, and then how to buy, what stocks you should buy, when should you buy, when should you sell, and then how much, so that you don't lose. I mean, when you lose less. When you buy, you buy more, or you make more, right? So then the emotions you go through, and then the routines, process, and system you have to put in place to support you on a day-to-day basis. And then how should you adjust and improve. So when it comes to the routine also, you have to again think back that if you're coming up with certain routine that you can't follow it 1 hour, make sure to adjust the routine, right? So so that you can do all these things in 1 hour. So that's the whole objective of our own trading system, right? So you might do it. I mean, initial days you might take couple of more hours, that's okay. But eventually you want to settle down within the time zone, and of course, I mean, timeline. Like, you might do, I mean, some of you might do it in 45 minutes. Some of you might feel like my trading system require 2 hours, which is okay for you, right? It's up to you guys. Even some of you could design such a way that only 15 minutes you spend on a daily basis, only in the weekend you will spend 4 hours. The whole idea is, on an average, you don't spend more than 1 hour on this, so that you can do whatever you want to do in a personal life, right? So that's the idea. So these are the things we are going to cover in the course, right? And I believe with this covered, right, and then gets the idea about what we are doing, you will get the conviction to follow, design and follow the system, and then make profit from it, right? So these are the things we are going to cover, and then we are going to discuss some of the ideas, like within the course, right? Some samples about what we are trying to do, right, in the next slides, and then call to action in the next the slide after that. So as you can see, the time is going to end. Let me once again, like, close the call and reopen again. Please join in the same link. Just anyone, like, tell me, like, so far it's okay, right? You guys able to follow?
Yeah, all good. Professor.
Okay. Okay, guys. Then we'll join again the link. Thanks, guys.